Are we live?
Maybe a lack of response tells us
we're live.
Okay, it says we're live. So I'm going to act like we're live. Hello, everybody. My name is Jason Feifer. I'm the editor-in-chief of Entrepreneur Magazine. I am so honored to be here to MC and drive a discussion about this great book right here, The Big Long, written by Colin Wiel and Doug Brien. There are lots of different ways you could pronounce their names, but that is how you actually pronounce them. We were just talking about that before we launched on here. The book, I will tell you, and we'll talk a bit more about it, or quite a lot about it as we go here, is, look, it's a number of different things. It's the story of their previous company, Waypoint, and then it leads into the development of Mind, a tech-enabled investment management platform that they're known for now. But also, and this is what really excited me, it's just such a great roadmap for big thinking, for the development of big ideas, for what it takes to pursue big ideas. And it walks through a lot of successes, a lot of mistakes, a lot of honesty, which is exactly what I love from entrepreneurs. So I'm excited to dig into it with both of you. So first of all, Colin, Doug, welcome to your own event.
Thank you. We appreciate you hosting and moderating for us.
Well, thanks. So we are under the assumption here that if you have joined us today, you're interested in either building something for yourself, building a business the way that these two guys have, or real estate investing. And so we're really going to be speaking to both of those audiences and ideas, because I think a lot of what you have in this book really speaks to both of that. And I have a list of big ideas in here, things that I want to talk about, but we also are very interested in what is on your mind watching right now. So feel free to drop in questions. I'll be seeing them. I'll integrate them into our conversation. But let's just start with this. Colin and Doug, you have an interesting partnership. You come from very different backgrounds. So set us up with where you both came from and how you came to collaborate together.
Sure, I'll start. I am an engineer by background, and originally mechanical engineering, automatic control systems. First job out of college was at Boeing, writing algorithms for automatic control systems, robotic systems on airplanes, and always was an entrepreneur at heart. So transitioned into software, kind of internet software in the early internet days, launched my first company in 1998 doing e-commerce infrastructure software in Java. Grew that company to 35 people and sold it. So it was pure tech by background. That was my view of the world. And after selling that company in 2000, began to dabble a little bit in real estate on the side, but really didn't know much about real estate, even at the time that we launched Waypoint.
Yeah. And so, Jason, to your point, our backgrounds are, I don't know, maybe as polar opposite as you could possibly come up with. Here Colin is a mechanical engineer. I guess the one similarity is we both went to Cal, although we had no overlap. So he was gone when I came in. But I played football, and I started out my professional career as an NFL field goal kicker. I went straight from Cal to the 49ers, and quite frankly, had no idea how long it was going to last. I never even tried kicking till I was a senior in high school, walked on at Cal, and I figured I'd give the NFL a shot. My real goal was to not be one of those players that had this amazing opportunity and then end up with nothing to show for it. And I wanted to set myself up so that after football, whenever that was, I could do what I wanted to do instead of what I had to do. And so I remember I took that first Super Bowl check and I went and bought my first piece of real estate. And that whole year, I'd really done a lot of research. I talked to everybody I knew. I read books. I had to have a strategy if I was going to figure out how to, not be one of those guys that had nothing to show for it. So my research led me to believe that real estate, literally was the way to create most efficient after-tax income and grow wealth over time. So started with a house my rookie year, rehabbed it myself, me and a friend, we literally spent the off season fixing it up, lived in it, made money, and then set the goal to buy a new property every year I played. And so I kept doing that. When I got to the New Orleans Saints, I signed a 5-year deal and decided to get an MBA since I was going to be living out in New Orleans and, not have a lot to do besides, Mardi Gras and Bourbon Street. Decided I'd keep myself preoccupied with something useful. So I studied real estate finance. And then when I retired in 2005, it was just like a completely natural progression. I'd been buying real estate all throughout my career, put myself in a pretty good position after 12 years in the NFL, and started focusing on buying large apartment buildings. But literally only like 18 months, 2 years later, the foreclosure crisis started to unwind. And that's where Colin and I met up. We were both in an angel investing group and realized that we were maybe the only two people in a universe that were interested in investing in single family rental. And so we decided to collaborate and start on this big, long adventure.
So before we go a step further there, pick up that story, because that story is in the very early parts of the book, and I want to ask you about it. But you said, just phrase, this is beside the point, just because I bet a lot of people were like, "Oh, what now?" First Super Bowl check. Do you get a check for being in the Super Bowl? What is it? Just tell people what a Super Bowl check is.
Yeah, I mean, the way the NFL works is you get paid 1/17 of your salary every week of the season. So as a kicker, it was worse than year to year. It was game to game. I was getting like 1/17 per year, especially in the beginning. And then the way the playoffs work is like everybody gets the same payout for first round playoff, second round playoff, winners, losers, and then Super Bowl. And so you get a check for each round. And obviously the biggest check is you win the Super Bowl. I mean, I think back in those days, it was like 75 grand. So it was real money. And I'd save money during the season too. But yeah, that was like, okay, I got to do something useful with this.
Yeah. Who doesn't want a Super Bowl check? Okay, let's launch into a number of the big ideas here in the Big Long. But let's set up with one of the foundational elements of your story is recognizing where a big opportunity is, where other people aren't looking or don't take seriously or don't believe. And I want to understand how you're recognizing those opportunities and how you're thinking through them. But you have a wonderful story in here about how the two of you, as you said, were in this group and everyone's talking about their favorite investment strategies. And the two of you are looking at single family homes or single SROs, right?
SFR, single
SFRs.
family.
Thank you. So sorry. As you can know, my area of expertise is entrepreneurship, not real estate. So you guys are gonna have to fill in.
We're going to help you out in that category.
Yeah, thank you very much. I appreciate it. I'm glad I have you to make me not look totally stupid. But you guys recognize an opportunity that everyone else in the room thinks is absolutely nuts, and yet you have some core insights and some important data to back it up. So can you tell that story? Because I think that there's something important there in understanding how the two of you are thinking and looking at market opportunities and seeing something that other people don't.
You want to take that, Colin?
Yeah, sure. Yeah, I'll jump in. So, we had both invested. I had invested at this point in a couple mobile home parks and a mini storage facility with a friend who knew a lot about those things. Doug was mostly focused on large multifamily. We never, during the good times before 2008, it didn't make a lot of sense to invest in single family rental because single family home prices were so inflated and the amount of rent you could get, it just didn't pay off. And then what happened in 2008 in some of the Bay Area communities where we started buying, like Antioch and Vallejo, home prices lost 70% of their value from the peak in a 1-year period. And yet rents didn't come down at all. And so suddenly we could get a higher cap rate, which is a real estate term, but a higher yield on single family rentals than we could on any other asset class in real estate. And it had always been the reverse that was true because single family homes were considered great assets. They were stable, they were desirable, you could always rent them out, but because of that, you get a lower return. But here it was the reverse of that. We could get a higher return on single family rentals. And we were pretty sure that had never happened before. And that was a big part of what drove us to feel like, hey, yes, prices are way down. They might go even further, but at some point, this is the Bay Area. This is the tech center of the universe. People are going to want to live here. They always are. And home prices are going to have to go up again at some point.
So it sounds logical when you say that, but you were in a room full of, I presume, smart people who did not see this as an opportunity, and you probably didn't even after you made that case. Now, one of the things that's in your book is a question that I love. It's so simple. I often ask it of myself, and that question is, what am I missing? And I love that you ask that question. You bring it up a number of times in the book, and it's a really important one because, of course, you could have been looking at this and saying, well, this seems like a great opportunity, but there is possibly something you were missing that the other people in the room weren't. Instead, it turned out to be the flip side. But talk me through that philosophy more generally, how you apply that, and then also as a use case, how you started to test this observation that you both had and recognize there really is an opportunity here.
Yeah, I mean, this is why you do due diligence, whether you're making a real estate investment or you're investing your time and capital in a new business. Like, you gotta really understand what you're getting yourself into. And in hindsight, I think in some ways, Colin and I were like at the perfect inflection point in our professional real estate career. It's like we knew enough to be dangerous, but not so much to be dissuaded like the more experienced real estate investors. And so we were kind of in this sweet spot. And we would, like, literally what Colin just said, like the two of us would be in a room or a car and we'd have that conversation and we'd be like, we're both drinking the same Kool-Aid. It's like, right? Yeah, but then there's this and this is so great. And you just couldn't help but think, like, why are we the only ones trying to do that? Like, it was just very clear, like, this was not a strategy that others were looking to employ. And so we literally did kind of go about our due diligence thinking, like, what are we missing? Like, we must be missing something. Like, cursory glance, this looks like the most amazing investment ever. And I think part of what helped us was, a lot of people get wrapped around the axle around, this concept of catching a falling knife. It's like, well, I don't want to buy into an investment that's like falling in value. And it's like, yeah, that's generally true. But if you really look at it as a long-term investment, and you can see that there like just has to be a floor somewhere for the reasons that Colin just mentioned, and you can get paid, a 10% plus cash on cash return to wait. Like, we had 10 years, like the debt that we set up basically was like kind of in the 7 to 10 year fixed rate range. And so we were just not that worried if prices went down another 10 or 20%. Like, you'll never get it right if you try to get it perfect. Don't let perfect be the enemy of good. Like, that's one of our sayings. And so we went out, we did a lot of due diligence and created sensitivity analysis. Like, what if we're wrong on the rents we can get? What if we're wrong on the amount it's going to cost us to renovate a property? And we would like literally, play with those by, 20% increments and realize we could be 20% low on the rents and 20% low on or 20% high on the rents and 20% low on the renovations cost. And it's still a really good investment. And it was that point where we really, I remember distinctly, and it's in the book, it was like literally Christmas Eve. We're like just trying to pull the trigger on our first investment and just like can't get over the hump. And we went and looked at this property and talking about it. And Colin, as we were walking out of the front door, he said, I finally figured it out. I think I finally figured out what we're missing. And I was like, what? Like, what is it? Like, it was like 6 weeks later. And he said, we are missing out on the best investment opportunity of our lives. Like, we're contemplating whether we should offer $69,000 or $71,000 for this house. We should be willing to pay $90,000 for this house. It doesn't matter. It's so cheap. The cash flow is there. The location is there. Like, what we're missing is an opportunity. We should start buying houses as fast as we could. And, we did.
Doug, you said in your answer there, we knew just enough to be dangerous. And that's a good reminder that you guys were not experts in this at all. And in fact, there might have been a real value to you not being experts here. It gave you the freedom and permission to look at something in a totally fresh way that maybe somebody who had a lot more experience than you would have just dismissed outright, because it didn't fit into their already calcified understanding of how the market worked. And this is a really inspirational point, and something that I think people who are watching should take notice of, that you don't need to, and I know both of you feel very strongly about this, you don't need to be an expert in something to do it, to pursue that opportunity. Doesn't mean that it's going to happen perfectly, and it certainly didn't for you. In fact, there's one of my favorite paragraphs from the earlier part of the book, which I'm just gonna quote you to give people a sense of what the journey was here. Did our hyper-aggressive, throw caution to the wind approach lead to some harrowing, bizarre, hilarious, and sometimes frightening occurrences? Of course it did. We've already mentioned being investigated by the FBI, and that was mentioned earlier in the book. Time of stress and apprehension that lasted about 2.5 years. There were the 7 CFOs we hired. We found naked drug dealers springing out of our houses. There was the time we saw someone murdered, and the pre-IPO investor tour where we were so punch drunk that we couldn't stop laughing. There were the countless times where we were a few weeks away from running out of money, none of which should be surprising, since neither of us, and this is the point that I'm trying to make, had ever done anything remotely like Waypoint before. We were making it up as we went along. But in so doing, you were clearing, or you were rather not scared off of a path that might have seemed too crazy for people more experienced than you. But that just means that they weren't willing to see what you saw.
Yeah, or that they literally couldn't. I mean, I think the best example would be, and this individual I don't think would mind being mentioned, Scott Sellers. He was the CEO of Archstone Residential, literally one of the large multifamily companies in the US. Like, there's like top 5, multifamily investors, and we got connected with him and did our whole pitch. And he basically said, like, okay, it was a $7 million fund. We're going to buy 100 houses. He said, I'm sure you guys will make good money. These houses are so cheap, but this is just like, it's just not a scalable opportunity. Like, you can't, like, it's hard enough to manage an apartment building where you have 400 units in one location. Like, it's impossible to like actually scale this. And he truly believed that. And I think most people who have been in the industry and had that experience ended up seeing it through a different lens, which convinced them that it was not an opportunity. And I think, when you look at a lot of, not just entrepreneurs who are kind of starting a new company, but kind of starting a new category, oftentimes it is someone from the outside who can just come in and see a new opportunity. And so one of the things I always share with people who are contemplating starting a business is they really do get wrapped up in this, like, do I know everything? Am I qualified? I don't know how to do this. And it's like, the reality is that a lot of people who end up being successful doing it can't say yes to any of those things.
Let's step back. The book is called The Big Long. We haven't talked about what the big long means. So let's do that, because I think it also leads to a great insights into how to think big, how to pursue big ideas. You write in here, we believe entrepreneurs have a responsibility to build for tomorrow, not just take profits today and head for the hills when regular people deal with the damage. Talk to me about your philosophy of the big long and why you feel like it's something that is important for you as business people, but also important to make sure that other people understand.
Hey, Colin, what if you hit that one, but also explain the connection with Michael Lewis's book, The Big Short? I think
absolutely.
That's like it's a play on that book and movie.
Yes. So The Big Long is a play on The Big Short, which was, I think probably most people on this call are familiar with that. It was Michael Lewis's book about the foreclosure crisis and how a few investors shorted the market, meaning betting against the market going up. They bet that the market would go down. They got it right. Some people made billions of dollars while there was total carnage, and millions of families in America were losing their homes and out on the streets. And that's a financial bet that people made, but it didn't serve society well, particularly. And but on the heels of the greatest crash in housing in any of our lifetimes, was a big opportunity to bet. It's in investing, it's called going long, which is you're betting that something's going to go up. And so this was like, we know housing has to go up. There's interestingly, what happened that led to the foreclosure crisis was an overbuilding of housing, because lending was so cheap, and people could get loans without proving their income and things like that. And so home prices went way up, but the supply of housing went way up. But then with the foreclosure crisis, new home construction ground to a halt. And we ended up with the lowest amount of new construction for about 4 years in a row, the lowest level since World War II. And all of a sudden, that excess vacant inventory got absorbed. And then we had a housing shortage. So that was, even in the early days of the foreclosure crisis, it was evident that the pendulum was going to swing that way. So the big long was our bet on home prices and the rental market existing for a long time and being scalable. And it was an important aspect of what we were doing, was that we felt like we were helping society. We were buying, usually they were boarded up homes with weeds growing in the yard. We'd renovate them. They'd be the best looking home on the block. People were able to rent them, oftentimes someone who had been foreclosed on themselves, maybe even from the very same house. And so we provided much needed rental housing. And it was an important premise for us in our careers that whatever it is we were going to do, yes, it had to be an interesting financial opportunity, but also had to be a positive for society.
You write, and I think you don't get to those kinds of large ambitions without thinking really big. You write, you advise people, start out thinking big. Start out thinking big. By thinking big and going long, this is me quoting you to you again. By thinking big and going long, when nearly everyone around you is thinking small or chasing short-term profit, you can build something extraordinary that helps people and even changes an industry. The challenging thing, I think, about starting out thinking big, as good as that sounds, is people might think, well, I don't know that I necessarily have the right big idea. I don't know if I'm thinking big enough. I don't know if I'm thinking too big. What does it mean to you to start out thinking big? And maybe what guardrails do you have on there? Or how do you start to validate big thinking so that you're not teetering into crazy thinking?
Yeah, I mean, I'll take that one. I think, it's a nuanced answer, right? It's like, thinking big takes, it takes gall to like really play this out. Like, what could this turn into? But, the truth is, big ambitions start with a single step, right? So we didn't like start filing our papers with the SEC right when we started. We started with our own money and we bought one house, like literally just one step at a time. And what you do is you get feedback and you learn. And that led us to be able to raise our first fund, a $7 million fund. Like, pretty modest. We slapped $7 million of debt on that, so $14 million. Successfully deployed that, learned a lot, started to build some systems. And so I think, yes, thinking big is important, but the truth is you got to do it one step at a time. And I think, Colin and I, and probably every serial entrepreneur, has taken steps down a path that they thought would be big, and they were wrong, right? So you stop taking steps. You stop at step 2 or step 3. I think the reason it was really important for us to highlight in this context, because whenever we talk, I mean, everybody remembers the foreclosure crisis, at least in our rough age range. And the story we usually hear is one of two things. Like, I saw this happening. The houses were so cheap, but I just didn't even know what to do, or I was nervous that they were going to keep falling, so I didn't do anything. Or you have someone who said, they were one of, the brave 10%, and they like bought a house or maybe 2. And like, they felt really good about that. Like they actually stuck their toe in, they saw an opportunity, they did something. But then they'll say to us, like, but like, what made you think to buy 17,000 houses, right? Like, how did you know to take it that far? And so I think, they probably took a similar step, first step or two like we did, but because we had also kind of tried on that hat of like what this could be, we had a mindset that we were just going to keep taking steps and keep taking steps. And like, even though we saw chasms and we didn't necessarily know what the bridge was going to be, we just had confidence, like somehow we'll figure this out. Somehow we'll, talk to mentors, find resources, get it wrong and eventually get it right and just keep pushing forward. So it really takes both, I think, to be successful.
And then one point I'll add to that is that I think a big key for us was we thought exponentially, not linearly. So when we bought that first house, we were already thinking about, well, then we want to buy two houses, and then we want to buy four houses, and we're going to need people, we're going to need a team, we're going to need to hire someone to help us, a construction manager. And then, fast forward a couple of years, and we were buying 25 houses a month. And we thought, okay, what is it going to take us to be able to buy 50 houses a month? And then when we were buying 200 houses a month, we were thinking, how can we buy 400 houses a month? And it was always this thinking of exponential growth, not just like, how do we buy another 5 houses every month?
When you're sitting at 200 houses a month and you're thinking, what does it take to get us to buying 400 houses a month? What's the answer to that? How do you start thinking exponentially? What are you actually doing so that you're, I imagine that part of it is that you're rethinking what your company needs from you, what kind of leader you need to be, the way that you need to assess the market, assess risk. But what, take folks into that from a tactical standpoint. What are you actually talking about at that point?
I'll start with this, and then Doug, you can chime in. But I think there were a couple aspects to it. We talk about people, process, and technology. Having the mix that Doug and I have, in terms of me being from a technology background, him being from a real estate background, played really well. So we knew we were going to have to build our own technology to be able to pull this off, because no one had done anything like this. So there was no SaaS platform for doing what we needed to do. And we made that investment. We hired people like Ali Nazar, our original CTO, helped build a lot of our technology platform. We made that investment in technology. And then the other thing is, on the people side, we recognized that, like, the person who's going to get us from, 5 houses a month to 10 houses a month isn't necessarily the person who's going to get us from 50 to 100 houses a month. Like, you need different people as the organization scales. And we recognize that, and we're able to kind of bring in the right, really high caliber people. It helped that we were in the biggest real estate crash, of our lives, and so a lot of really great people in real estate and in technology were available that we were able to bring in.
Yeah, and I guess along those lines, I think this is like a really important skill set that any entrepreneur has to have, and I think it was one of the things that Colin and I, for whatever reason, were just sort of like naturally good at, was to like be able to like really be intellectually honest with ourselves about like what we're good at, what we enjoy doing, where we add the value, and then looking at the broader opportunity and seeing where we had gaps, right? Things that neither of us did well or wanted to spend our time doing, and then attracting, going out and recruiting other people and selling them on our vision so that they would join us and collaborate and fill in the gaps. And, when you're growing that fast, it's like a constant exercise of reassessing. And, the things that I did in the early days had to vastly change as we grew. Same with Colin. And if you don't do that, that is where you get, you get capped out and you can hit ceilings.
In just a few minutes, I want to pull in some questions from the audience. We've got a few sitting already, but I would love to hear you guys speak just for a moment about another answer to this question that was in the book about how to think big, how to validate ideas. You talk a lot about the importance of data, something that I'm sure is just as important back then as it is today and every day at Mind. And and you write often about the importance of that. For example, to go big on an idea, there comes a point where you have to trust your data and your gut instinct and make the leap. Can you speak more to, and perhaps even with a mind towards the people who are on this call who are involved in real estate investing, how to really think through that data, how to test data, how to make sure that you feel like you are seeing something clearly enough that you can make a very large bet on and can pace yourself towards that exponential growth?
You want to take that one, Colin?
Yeah. So as when we scaled buying single family rentals, so it wasn't just us, making offers from, making a whole bunch of offers, but it was, we had a whole team, we had a whole system. Data played a really critical role in that, and so we had quite granular data at the time, for things like school quality, crime levels at the neighborhood level. We also had our own proprietary neighborhood score where we would look at how safe does a neighborhood feel? How noisy is this street? What are the surrounding uses? Is this house, 3 doors down from a gas station? That's not good. Things like that. And we had a computer platform where we would process. So the moment we were tied into MLS systems, which was harder to do back then, and the moment a house would come on the MLS in a market where we were buying, we would instantly have the software would develop a maximum price based on the estimate of rent, based on these different qualities of the neighborhood. How much do we think we're willing to pay? Then we would still have a human put eyes on the property before we would buy it, but a lot of it was this data-driven process, and it was something that we had to learn to trust the data. Like, we had to test the data and see whether it really worked. And so we, for every house that we bought, especially in the kind of the early to mid period of the company, we would say, okay, we bought this house. Now, did it rent? 60 days later, did it rent for the price we thought we were going to get? And if not, why not? And with especially an eye towards what's the quality of the neighborhood? Did we get it right? In terms of our neighborhood score and all of that data.
And then the other aspect I think it's important to highlight is, a lot of people, when they ask like what created or what allowed the single family rental industry to emerge when it did. And, the obvious answer is the foreclosure crisis. But the less obvious truth is that it also had a lot to do with the advent of cloud and mobile computing. Because if you think about prior to those technologies, and look, this is largely probably why those experienced real estate investors said it'll never work, because you have to drive out to these houses and maybe you have some printed out papers that have some data about what you're looking at. And then you'd be out at the house and you take notes on a yellow pad and go back to the office and like enter it into the system. It's like, that's a nightmare. Whereas what we were able to create with iPads and cloud computing was a software platform that allowed our teams in the field to have visibility into all the data they needed to do whatever they had to do at the house, and to input the data that they were seeing, so that everyone on the team could see what's going on with rolled up data and dashboards. And so we were able to innovate back in the day and kind of create, it was somewhat of a Franken system. It was not one system. We pulled together a lot of systems, and frankly, that's still how single family rental works today. And this is why we started Mind almost 6 years ago. We're making a big investment in building the technical infrastructure, the platform that's specifically built for scale and single family rental, so that all the various operations that happen in this, very complex operating business are all in one system, and all of that data is able to be harnessed, and we're able to make better decisions because of it. So software is a big part of why this industry has really taken off.
That's actually the origin story of so many great companies, which is that they created a solution and then realized that this solution was scalable or gave them insights into something that a broader marketplace needed. I think of MailChimp, for example, which I think began by providing a whole bunch of different services to people. And then they had built this newsletter platform, and that turned out to be so valuable that it became the business. And in a way, what I love about your answer there is that it was a great dive into the importance of data and looking at it, but then also thinking about how do you make it most useful and also create a competitive advantage by creating the systems that can help you understand data. And then once you've done that, you've actually also created the beginnings of something that can be so useful for an entire industry. And now you've got a new business opportunity.
Yeah, the truth is we made a lot of money for large institutions and Wall Street investors with Waypoint. And when we merged it with Colony American Homes, which then went on to merge with Invitation Homes, which is the largest single family rental operator in the US, that was a time for us to step out because it was just a lot less entrepreneurial. And our real vision was to have a much, much bigger impact on the industry. And we realized we learned so much. And if we actually raised venture capital and really invested in the technical infrastructure, we could add the same kind of value that we just did for large Wall Street investors and do it for everyday individuals. Because the truth is, when you ask people, it's almost everybody wants to invest in real estate or wishes they invested in real estate, and they just don't know how to get started. And part of it is just complicated. You got to go find a broker, and then you got to figure out how to get a loan and insurance. And then, oh my gosh, who's going to manage this? And, the technology and scalability of management is just all severely lacking, highly disconnected. And so our vision was, let's take what we use to make Wall Street money and bring it to Main Street so that everyday investors who want to own a house or two, it makes it a lot easier and also enables remote investing. One of the, I think, most tragic statistics with real estate is that 85% of investors invest within 60 miles of where they live. What's the chance that that's the best place to invest? It's pretty slim. And, do you feel like you need to live within 60 miles of Coca-Cola in Atlanta if you're going to invest in Coca-Cola? No, you invest where the data tells you the best investment opportunities lie. And so what we've done at Mind, we're in 25 different markets. We've done the heavy lifting, figured out where those markets are. And in all these markets, we can help investors buy. We do the financing, we can provide insurance, and we do the management. And all the data is in one system so that people can more easily have diversified portfolios of real estate, which makes it easier. And just the diversification into other markets besides where you live makes it a better risk-adjusted return.
Maybe this is a question you get often, but it's one that's been sitting here for a while. It comes from Ray Milhem. Sorry if I mispronounce your name, who has been real enthusiastic about the things that he's hearing from you guys. Loved the phrase capitalism with a heart. But Ray asked if you have plans to do commercial real estate one day and also expand to Canada or other countries. What's the thinking there?
Well, like we've talking about, we're never lacking in big thinking. So, I think those things are all out there in the realm of possibility. But going back to what I said earlier, you got to get to these big visions one step at a time. And the reality is we have a massive single family rental industry here in the US. It's over $4.5 trillion of total value. I think almost 17 million homes. We manage less than 12,000 right now. So we have plenty of work to do kind of here in our own backyards. But, I like the thinking, and it's certainly in line with how we think about it. Single family is the hardest. Over time, why can't we do 50 unit buildings? Why can't we do 100 unit buildings? all those same building types exist in Europe, in Asia, and Latin America. So there's absolutely a massive opportunity here. And, we're 6 years in, really more like, 13 if you include Waypoint, and there's still a long, attractive path out there in front of us.
Jag asks, pretty specific question, but might as well be of service here. Does Mind help with 1031 exchanges?
We're not a 1031 accommodating company yet, but I think that's something else we could do. What we do is work with 1031 accommodators. So if you have a property you want to sell, we can connect you with a company that can, manage that process. But then I think the most important thing is we can then help you deploy that capital into other investments and help you get your up leg done in time so that you can avoid paying capital gains taxes.
Guys, we just got questions coming in that are hyper specific now, but it's what people want. So I'm just going to grill you for the next couple of minutes. Kyle Jones asks, do you do Section 8?
Yes, we do.
There it is. Simple and straightforward. Simple. Angela asks, do you see a way to evolve from SFR to BTR and offer investing in BTR to those that are not big lenders or players?
I mean, I assume we usually call it B2R, but BTR.
She blame me because I'm reading things that I might as well be reading Japanese language right now. I don't know what this stuff means.
So I think what she means is build to rent, which is basically brand new homes built specifically
yes.
for single family, sometimes in concentrations. And so the answer, again, simple, yes, we do that. We love brand new homes. They're actually a lot easier to manage.
Mitch asks, what does the future of acquisition of PM companies look like for Mind?
It's a good question. We bought a lot of companies up until 2019. And the truth is there are some challenges with that in that you're basically, we're not technically ever buying the company. We're really buying the contracts, but you're buying it from the owner of the PM company. And the owner of the property is not necessarily choosing you. And so, there can be some friction in that transition. And we've gotten really good at just organic growth. In December, I think we brought on 600 homes just in the month of December. And that's like advertising the Mind value proposition and investors signing up with us. And so we found that to be a better way to grow. But that does not mean that we've, totally written M&A off.
Kyle Jones, VP of Acquisitions, has a highly technical question. Doug, get ready for it. Do you ride the Peloton in the back, or does it just sit there?
I wrote it this morning. Yes, absolutely is used often.
That's great. Ray, by the way, who asked one of those earlier questions, says, thank you. Keep up the great work. I'm a happy owner with Mind and promote you all the time with family and friends.
That is awesome. That's music to my ears. Look, property management's a hard business. That's why we took it on. It's really hard. It's really complicated. I hate to say this, but sometimes it's almost who can do it the least bad because there's just so many things that can go wrong. And so we work really hard to get it right. And so I love to hear that positive feedback.
So both of you, this has been a fantastic conversation, and we're at the end of our time. I wanted to ask you, as a kind of final thought from both of you, to maybe share something that you hope people take away the most, or take to heart, or implement into their business growth or investing strategies that comes out of the big long.
Can we go, Colin?
Sure. Yeah, I think what I would hope people take away is a little bit of inspiration to tackle something big. And tackle it with enthusiasm and grit and perseverance and see it through. And I think the entrepreneurial journey is so fulfilling. I hope more people do it.
Yeah, go big. Like, you only live once. Like, who cares if you fail? In fact, I actually think you learn more from failing than you do from succeeding. So I hope people read this and say, like, geez, like, they're right. They really didn't know what they were doing. They just kind of figured it out. Hey, maybe I can too. So I think, look, the reason we did this was inspiration. We feel very blessed to have, been on that journey and had some successes, and we wanted to share the war stories and the learnings with lots of folks. So we're really excited about the book coming out. And Jason, like, we've done a lot of these kind of, moderated interviews, and just want to thank you. Like, you did a really, really great job. You're really good
thanks.
at this. And you also have a book coming out that, we bought some copies at Mind, and I'm really excited. You want to just end with a quick plug on your book?
Oh my gosh. Well, I don't want to end your book event with my book.
It's okay. We've already sold them. Yeah,
no, I've already sold them. It's called Build for Tomorrow, which is a phrase that I not only saw in your book, but also then quoted back to you. We believe entrepreneurs have a responsibility to build for tomorrow. That's you, not me. But my book is called Build for Tomorrow. It's about how to become more adaptable, how to use change as moments of change as moments of opportunity. It comes out September 6th, so anybody can find it and pre-order it on Amazon right now. But that's not what we're here to talk about. We're here to talk about this, but I appreciate you prompting me for a plug.
We're going to read your book too.
I really enjoyed reading this. I enjoyed this. I will tell you, poolside in Mexico, a lot better than the freezing bedroom in Brooklyn, New York, where I am right now. But just by holding it, I have some memories. Colin, Doug, this has been a pleasure. Thank you so much for sharing your wisdom, your story. Thanks to everybody for the great questions, especially to Kyle Jones asking about the Peloton, which was like the one question I actually understood, and you had a good answer to it. And and everybody, go pick this book up. It's great. You'll learn a lot.
Thanks, everybody. Thanks, Jason. Yep. Take care.